Welcome to Intelligent Investment Live with Matt Dahl of ARPG. Matt, how was the holiday Christmas party last week, by the way? I think that's where I left you off. You were getting ready to take the Friday off to party with the team. How did everything go there?
It's great. It was a wonderful dinner. We had a wonderful, great after party. Everyone had a lot of fun. Being we're in Las Vegas, that's the NFRs in town, the National Finals Rodeo. So there was a lot of cowboys and stuff running around up there, and it was a lot of fun. I got myself a cowboy hat and I was wearing it. Don't look like a cowboy, but I think I pulled the part pretty well. So this week it was one of our staff members' birthday party. So we take them out to lunch on their birthday. So I had one oyster yesterday, and it's decided it wants to fight back for the heavyweight championship of the world. So I'm a little pale today, but that's okay. The oyster's winning.
Yeah, I actually had my very first oyster not that long ago. This is probably it was like late October, I think it was. I didn't mind it too bad, but one of the guys I was with tried. Let's see, I guess the ones I were eating were cooked. He tried some raw ones. Did not go well for him. It was ugly.
I'm pretty sure I've lost about 15 pounds today. So I mean, when I walk around, it's just like I'm just light. I'm light on my toes.
Yeah, and I don't want to ask. I mean, I'm trying to lose weight, but I want to ask you how you've managed to lose 15 pounds in a day. I can kind of imagine. So we'll leave it at that.
I'm on like the fourth or fifth pass belt loop right now. It's great.
Oh, nice, sweet.
Yeah, I've been cartoon ladies.
I've actually been working on that. I've been going to the gym lately and watching. I've been mostly what I've been doing at the gym has not really been for fat loss. It's been more for strength. But I've still been trying to watch what I eat, and I've gained like 4 pounds. I don't get that, man. I think it's just getting older. I did start a.
You're probably drinking a lot of water now.
Yeah, water. That's what I'm thinking it was. Yeah, we'll go with that.
It's water weight.
So we enter probably when I was an advisor. This was probably it's not the most boring time of year, not the most exciting time of year. It's a very unique time of year. The markets tend to be fairly quiet around the holidays unless something crazy goes on. You get some, tax planning, and you might have some tax selling or tax, some things that can shake it up a little bit. But for the most part, it seems like late December was always pretty calm. Depending on the practice, it could be a busy time for advisors because sometimes you get a lot of clients calling for tax statements, things like that, or tax planning purposes, I guess. So it can be kind of a calmer time for the markets. We're not particularly volatile right now, but we really haven't been for several weeks. So is the calmness right now in the market just seasonal? Is there just not a lot going on? Do you expect it to continue into the end of the year? What you seeing?
So today's actually a quad witching day, and today is on track to be the highest volume day ever.
Really?
Yeah, big day.
Boy, so, talk about contradicting exactly what I just said.
Well, no, it's not volatile. It's not volatile. It's just lots of volume today, right? So you're right. It's relatively calm. I think the VIX today is 15, 16. And that just lets us know kind of what we could expect on an outsized move of the market on any given day. I mean, the old rule of thumb is the VIX divided by 16 gives you kind of rough idea of what the market's pricing in for an intraday move, right? So it can move obviously 1% in either direction. At 16, it can move 1% either direction. At 24, it can move 1.5%. We've been having outsized move the last 3 weeks of almost 3% here and there with the VIX moving up to 24. So the VIX market has actually been the VIX itself. And the options market has been a lot more calm than the actual market has been, which is interesting. So some of those days we moved 2% and 3%, the VIX was telling us it was only going to be about 1.5%, but it moved more than that. The first part of December is usually pretty choppy and can be pretty ugly. And the second half of December tends to, obviously there's a Santa Claus rally, which is the week between Christmas and New Year's and the first 2 days of January. And the average return during that time period is 1.2%. So those things are likely going to happen this year. We haven't had a Santa Claus rally in a couple of years. We've had some pretty ugly beginnings of December the last few years, including this one. The beginning of this December, I think we're down about 1% so far from beginning of December too, where we had, a few days ago. So, we haven't really had anything to really write home about in terms of December. So, however, we're past CPI, we're past the FOMC, all that stuff has been digested now. So I think it's kind of clear sailing, and I think we're probably going to get a significant rally between now and end of year. So we're sitting about 68.30 on the SP right now. I would expect probably another 120 S&P points, 150 S&P points by end of year, which puts us right at the top end of that range, about 7,000, right, about 2% upside from here. That would be my guess. It will depend on how far the momentum takes us. Anything can happen. I mean, 2% move inside of 2 weeks is not that big of a deal. So we'll just kind of see what happens and what some of the communication that comes out between now and then. I mean, obviously the CPI report came in Wednesday, and the equity market was like, party on, 2.6% core CPI year over year. Let's do this. And the bond market was like, wait a minute, are we sure? Sure. And yields barely fell, right? Yeah. So now we're getting a lot of communication from the fixed income side that they don't believe this number. It's too distorted from the government shutdown. And they're right, it is distorted. But, no one really knows. No one really knows, because we still have consumer confidence at its lowest ever, lower than 2008. Okay. We don't have a tremendous amount of confidence right now. So I would expect, and we're actually seeing deflation in the housing market, which is the biggest component of the CPI calculation. So if that thing starts to wiggle, it's going to move that number significantly. You know what I mean? It's kind of like if you don't have your biggest lineman on the line that day, you're going to lose. Right? He's all of it. That's by far the biggest component of CPI as far as that calculation is concerned. So it's not disinflating; it's deflating now. So when you start to put the negatives inside of that calculation, it's such a big part of it. I believe housing in and of itself is about 44%. It's going to pull the whole thing back pretty quick. So I wouldn't be shocked. If that number wasn't correct. Okay. Now, if you bring in to what Chair Powell said during the FOMC in regards to last week, in regards to the job that he believes that the data is distorted by 60,000 jobs a month. So when we put on 60,000, that's actually zero. We put on 40,000, that's actually negative 20,000. So that leads us all to the same conclusion that, the rate cut in December was kind of a given. The rate cut in January, I think, is less than 50-50. And the data that we get in the beginning of January will probably change that outcome a little bit. But I think we can probably look dead at at least three cuts next year. And again, 3 cuts next year, good earnings. I mean, yes, S&P is probably going to go by 14.50. Morgan Stanley has earnings growth next year at 17%. But again, next year is over. We're looking at 2027. But if you look at 2026 and 2027 on the NASDAQ, right, that looks really good. I mean, you're looking at 2026 growth at 25% and 2027 growth at 21% on the NASDAQ. So there's still a lot of tailwinds out there. And we're going into a lower interest rate environment. And we've seen the consumers sort of sit on the sidelines for the better part of, they're strong and they're still spending, but consumer confidence just hasn't been there. So I think next year and the year after, I don't think next year is going to be a knock the cover off the ball year for the market. If we finish here at 7,000 this year, my guess is we'll finish next year 77.50 to 78.50. So if you pick a mid spot, 7,800, you're looking at about 11% return next year. That's not bad. But if you want something better than that, you're really going to have to dig in for your sectors and your individual security positions if you want to get that alpha. In our sectors we like next year. Obviously, we like tech. We like the subsectors. We actually like software. Of course, we like semis. We like financials. We also like certain parts of small cap value, like your regional banks, things like that. And we think that's all going to play into home builders. Home builders, we are going to have a really good year next year. They've underbuilt for a long time. Rates are coming down. I think there's going to be a pretty good demand for that next year.
You talked about the government shutdown. How long is it going to take for us to fully digest the effect of the government shutdown in terms of the data? I know we talked about it while the shutdown was still going on, that basically the data, we didn't really get any data, I guess, in November. then that kind of added some weight to what comes out in December. When will we be back on track with, okay, now we can trust our data again?
I would say probably February or March. Okay, because we have to have at least 3 solid months of full clean data to look at. Like December is going to be distorted because everyone came back to work at the end of November, and what does that look like, and what does that spending look like, and who knows? So I think December is going to be a little distorted, less of course than November was. January will be clean. February will be clean. So you can probably believe the month over month numbers inside of February for January, but I'd really like to see the numbers, in March for February, and then have a look back a couple months. I'll bet you the revisions that we have on the following month from the previous month are going to be pretty big, pretty big revisions, just because the data it just wasn't clean.
And does the market, I don't know how to even say this, has the market properly anticipated those revisions? And I say it's kind of funny to say it that way because you can't really predict what you don't know. You can't really anticipate an unknown variable, but has the market's usually pretty good at reading the tea leaves and kind of seeing between the lines. Does the market kind of know what revisions we're going to get and kind of price it in, or is that a total wild card?
I think the equity markets saw that number like, sweet, called it good, and they're not going to care about the revision numbers till they actually show up. The bond market's a different story. Okay, here we are talking about the boring bond market again, right?
Yeah.
With the bond market, like I said, they side-eyed that whole CPI report. Okay, and they're going to look at the revisions next month and the month after to start looking at yields. And I'll bet if the revisions are as bad as I think they are, I think that's when we're going to see yields really start to cave in, especially on the 10-year side. I don't think we're going to get a lot of movement necessarily on the longer end of the curve. Okay, I think the longer end of the curve, 475, 485, up to 5%, is going to be, it'll probably live mostly in that range for a variety of reasons. Although rates are coming down, there's still a lot of long-term growth. There's still some issues in regards to Federal Reserve independence, which obviously is not good for the longer end of the curve. But that pressure on the longer end of the curve attracts buyers, right? Which will keep that longer end of the curve kind of, because now we have policy rate at 350 on the low end. We've got the 10-year effectively 410, effectively 4, and we've got the 30-year sitting out at 485. So we're starting to see a lot of steepening here, which is nice. We're getting that bull steepen. So clearly the bond market is looking at the 2-year right now. I think it's 340 today. It's seen that disinflation number come in. Okay, so those bonds are looking less attractive to the longer end of the curve, but they're looking more attractive to perceived inflation, right? So I think we're really gonna see a cave in of that sort of that 2 to 7 year, belly of the curve, and the 10-year will come down, maybe not as much as a 5, but I think the 30-year is probably going to live in a 4.5 to 5% range. In fact, it's not really going to go much out of that simply because of the risk that's out there, but the attractiveness of the yields that you're not getting now on the short end of the curve.
And you mentioned consumer sentiment. You've talked about the consumer quite a bit in recent shows, but do you have any idea why is sentiment so low? I mean, the market's great. Things have been, the economy's healthy. Why is consumer sentiment on the low end? Why are people not really buying into it? I know you call this the most hated. Well, I don't know if this was this. When you say the most hated rally of all time, that can depend on time frame, I guess. But the consumer's been people have been pretty pessimistic for the entire run.
Right. So the most hated rally, that's 100% from Tom Lee from Fundstrat. He's called the lows on April 9th to now the most hated V-shaped rally, and he's 100% right. He's 100%. Although it's gone to the moon, people have, we've not seen the AAII sentiment reading over 45. We've not seen people get bulled up. We've not seen any of that exuberance happen. But we've just seen this, this strong market come back in. But we've not seen and people have been looking for reasons to sell. You know what I'm saying? So the reason for the consumer confidence, this is where it gets kind of granular of how that survey is actually put together. Okay. And if you take that sentiment and you break apart Democrats, independents, and Republicans, they have recently been surveying a tremendous amount more Democrats than Republicans. Okay. So all the Democrats have a very negative view on the economy. They're not confident in the economy. Republicans are very confident in the economy. Independents they're kind of in the middle. But it's the pure skew of the respondents in that survey that's moving it down. If they were, if they were to simply make sure we have 33% Republicans, 33% Democrats, and 33% independents, you would probably get a different picture, a much more sanguine picture. It might not be a great picture, but it'd be much more sanguine than it is now, right? So, and that brings into the credibility of that survey data, right? It's not hard data, it's soft data, which is why I know not to really look at it too much. I really don't care, okay? Because I know, A, I know how that survey is put together. B, I know the makeup of that survey. And C, it's just how I feel. It's not actually what happened. So the problem is that consumer confidence data, the Michigan sentiment data, that comes from the University of Michigan, it bleeds into all aspects of financial media. And folks look at it and go, oh dear,
Yeah, and it's like I'm a big Carolina Panthers fan. You talk to a bunch of Carolina Panther fans and ask what our record's going to be, you're going to get a number. It's probably not going to be an accurate number, right? It's important when you're looking at whatever data you're using to make your decisions. You need to know these types of things so that you can factor them in. And even if there might be a scenario where you would care about that data point, but it would have to come from your knowledge of how it's constructed in the first place, right? If that somehow totally flips or something changes in that, knowing how it's put together and knowing who its survey respondents are can have a big impact on how you read it, I guess is what I'm saying.
Yeah, absolutely. But again, we think next year is going to be a really strong year. And I mean, I hate to be boring, but I think tech is going to lead the way, like it always has. It will have some serious competition next year from small caps, I believe. Okay, industrials I think will really show up next year, maybe even a bigger way than they did this year. Not to the level of tech. We're seeing ISM still below 50, so we're seeing the market price in it coming back. So I believe the the industrial sector is up about 15-16% this year. And I think tech will probably go north of 20 next year. So next year is going to be about kind of pulling the S&P 500 apart and really trying to point and shoot at the right areas. If you buy the S&P cap weighted, you probably do okay because it's so tech heavy. However, I would be willing to bet that the equal weight will actually outperform the cap weight next year, okay? Because I think we're going to have a real breadth expansion next year, okay? Which normally it's about a 50-50, but the last 5 years, the cap weighted has actually taken the equal weight out to the woodshed and beat it senseless. So, I think next year, although it's going to be, I know I just kind of talked out of two sides of my mouth saying, well, you got to pick your sectors and you really get granular, but the equal weight will outperform. I think that's true.
Well, which there's a couple of different equal weights. You got your cap weighted, you have your equal weight. I know that's 500 different companies at 0.2% of each. Isn't there an equal weighted sector as well, where it's
yes.
10%, where it's certain percentages to each sector?
Correct.
So which of those, when you're referring to the equal weight, are you referring to 500 individual companies or the sector level?
The sector level.
Okay.
The sector level. So that's exactly what I was getting into. Is I want to look at the sector level on the equal weight sector in industrials, equal weight sector of financials, and I might split tech. I'm going to get into the subcategories of tech. Yes, I'll have cap weighted tech. Yes, I'll have equal weighted tech. We're going to have software in there. We're going to have semis in there as well. Okay. Healthcare, no. Medical devices, yes. Okay. Medical technology, yes, because those are going to benefit tremendously from a lower interest rate environment.
And the underperformance of I can't tell if this is a profound question or a really stupid one, but the outperformance of the market cap weighted indexes for so long, that's in simple terms, that's just the big companies getting bigger and the small companies kind of lagging behind. Is that a trend? I mean, to some extent, that is capitalism at work, right? I mean,
Exactly what it is. It's
right.
merit.
Yeah.
It's merit. I mean, what we're doing is we're discounting future cash flows into today's price. So we look at earnings growth back to the S&P and the NASDAQ. The NASDAQ is more tech weighted than the S&P, of course, right? So the S&P is going to grow by, call it 14, 15% over the next couple of years, give or take. The NASDAQ is going to grow by 25 next year and 22 the year after. Okay. So if I'm going to deploy client capital, I'm going to deploy, I understand the NASDAQ is a little bit more expensive on a multiple basis, but when you look at the ratio, they're very, very similar. And the probability of the outperformance of earnings on the tech side is higher. And it's not so much about 2027. It's also what about 2028 and 2029? That's where you have to look. So, back to skating to where the puck is going, not to where it is. That's the point of that is, when you look at the durability of that growth, it's not just the growth, it's the durability of that growth. Because if you're always shucking and jiving through your portfolio, making changes, well, you're chasing more than anything, and you can cause a lot of tax problems. You can cause a lot of your gains to go away in a hurry.
Well, and what's the catalyst for that then? As just maybe a curveball, hard question to end on, but what's the stick that's going to hit that puck in that direction to help the small companies have a better chance to outperform against the NVIDIAs that are out there? I mean, you've got some behemoths at this point that are, they're kind of running everything in a lot of ways. They've got huge market share and huge competitive advantages. So on some really, really high macro level, to say you expect the equal weight to outperform is not exactly. I'm not trying to put it so boldly as to say it's contradicting that necessarily. Some of it's just valuation and where's capital going to go and things like that. But at some fundamental level, that means that something has to change to make the small guys have a little bit better chance to perform relative to the big ones. So is there a catalyst in mind that you see changing that, or what's hitting the puck in that direction?
It is a top down, not necessarily from the market itself, but like the head of the snake. You got to cut the head of the snake off, right? So it's the head of the snake. So if you look at the behemoths, the Apples, the NVIDIAs, the Googles, they are not vertical companies. Okay. You don't walk into NVIDIA and they design and make and manufacture and create the chip and all of the little pieces in the chip and make the aluminum and the little graphite and carbon fiber pieces that go into the chip. That's not who they are. There's an ecosystem that surrounds them. And it's that ecosystem you need to look into. That's why you have to start with the head and find out what that ecosystem looks like and who's involved. Yeah. And then as interest rates start to come down, you'll start to see a lot of those companies needing to get access to capital to be able to fill, to continue their partnerships with these behemoths, right? So that's one. So if you look at the cost of capital coming down to them and potentially sales going up, pretty easy.
Yeah. So it's not predicting. It's not so much a prediction that the smaller competitors are going to start to gain market share. It's that the smaller contributors to the success of those bigger companies are going to be able to benefit from rising tide lifting all boats type of thing.
Right. I mean, if we're a venture capitalist firm, okay, different story. That's those guys. They're looking into these smaller companies and they're trying to figure out do they have the new mousetrap? Do they have the new bread slicer? Do they have the new thing? Okay. And are they going to take market share from the behemoths? Our job is not necessarily that. Our job is to deploy client capital to much more durable, much more well-known ecosystems, financial investment ecosystems, right? And that's where we have to look at those earnings, on the tech side, on the healthcare side, on the industrial side, and the companies that are involved and who's providing those earnings, who's providing that earnings growth to that sector. and look into their ecosystem and say, okay, well, where are they receiving, their materials from? Who's creating chips? I mean, Taiwan Semi is the maker of the chips, right? So that's why we came out of it. AMD this year, we had NVIDIA and AMD last year. This year we have NVIDIA and Taiwan Semi. So we're looking down that road. We're going to run down that rabbit hole and start to build that out a little bit. And we think the smaller we get to a point, but there has to be some level of connectivity between that and obviously your heavyweights, or you're taking a lot of additional risk for no real purpose.
Never a very wise thing to do. That's general wisdom. So, well, thank you as always for your time, and Merry Christmas, Happy Holidays to you. Won't talk to you again until then. We'll see you one more time before 2026 rolls around. For listeners, viewers, if you would like to speak with Matt, we're just here for information purposes. But if you would like to chat with him or someone at his team, you can give him a call at 702-655-8300 or visit intelligentinvestment.com and learn more about ARPG and Matt and his great team over there. Matt, great to see you as always, man, and see you again next time. Hope you have a great holiday.
Likewise. Talk soon.
See you, man. Bye.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risk, and there is no guarantee of any future results, performance, or success.